Neeraj Gambhir, Managing Director, Co-Head Fixed Income India of Nomura Capital, now joins in on the show. Neeraj, thanks very much for being with us. To start off with, there's the weakness and the volatility really that we've seen, which has been fairly dominant in the rupee. Given that all of the fundamental factors really seem to be stacked up against it, what are the levels that you're watching out for?
I think rupee has been very volatile, driven by a number of factors. One is obviously the global sentiment on risk off and risk on. The second aspect has been the RBI's intervention or suspected intervention. We don't know for sure, but it is being believed that they have been intervening in the market. So that's sort of driving the incredible volatility that we're seeing in rupee today. You rightly said that the fundamentals of the currency are looking weak, with the current account deficit at very high levels, and this quarter is in some senses a seasonally weak quarter from flows perspective and from balance of payments perspective. I think it is expected that the weakness may continue. It's a little bit difficult to hazard a guess around the levels because there are so many factors which are driving the currency at this point in time, and to some extent rupee is also driven by the levels at which RBI is sort of seem to have intervened or some administrative measures have been taken. If you go by the history, in the recent past, 54.30 was the high that RBI that rupee made, at which RBI had sort of intervened quite aggressively. There were a whole host of administrative measures which were brought in. So I think clearly from a trend point of view, that's one level that the market is going to watch out very clearly for. A break of that level could potentially lead us to significantly higher levels, but I think in the near term from where we are, I think that's one level which one would watch out for.
Right now, Neeraj, there are many who argue that you will see the rupee break even the December level of 54.30, possibly go to 55, some even arguing that it will go to 56. There's another counter argument being made that on a real effective exchange rate basis, the rupee is somewhere right price. So ideally from here on, you should see it appreciate possibly to the 50 level. Which side would you be on?
I think I'm in a little bit on a depreciation camp because I believe that the fundamentals of currency are driven by the overall balance of payments dynamics rather than just a theoretical, real effective exchange rate valuation measure, which is a good guide over a medium term. But I think in a short term horizon, I think that measure may not be very helpful in terms of predicting the direction. So if you need to think about the direction of the rupee, I think that the flows, the overall balance of payments is something which is more important. And as we all know that the balance of payment situation is not looking very good, and the flows have been extremely weak. So I think there is a case for weakness in the currency. Now the level per se is something that you can continue to argue and talk about. My feeling is that we could potentially see another 4 to 5% depreciation over the next 6 to 8 months. The factor that you need to watch out for is what happens to oil prices. If obviously the oil prices sort of correct down substantially, then that's a positive for rupee, and that could lead to some sort of relief in terms of the pressure. The other factor that you need to watch out for is a global sentiment. If there is a massive risk on rally like we saw in the first quarter of this calendar, then you could again see some kind of appreciation bias creep in. But I think from a broad fundamental perspective, I think it's a bit of a depreciation story.
Neeraj, the bond market is under quite a bit of liquidity as well as supply pressure. Do you believe that this bearish phase is likely to continue in the absence of any positive triggers? And how do you believe the bond markets are likely to read into the recent OMO announcement?
So OMO announcements have been a bit of a surprise and positive for the market. Clearly the markets have actually taken a very strong feel from that announcement, and we've seen almost like 20 basis points rally from the top. I do feel that we've sort of exhausted that rally, and from here onwards, once again, the supply will come into focus. We will see the song and dance about, RBI intervention through OMO, through liquidity, injections, and the supply-driven sort of factors play out in the bond market. I think over a longer period of time, clearly the size of the supply itself is a big issue, and any expectations or any chances of slippage on fiscal deficit account, can lead to further pressure. Sure. So I think that the trend and directionality should be on the higher side.
Correct.
But it's clearly difficult. Right.